Hello and welcome to the market update here for Tuesday, July the 25th. If you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. Before we get started, I just wanted to, a couple things. First of all, hopefully you don't hear any sounds of a hammer in the background or something like that. I'm having some carpeting put in upstairs, and so I'm in the basement today doing the class. I think for the most part there's enough separation where you won't hear anything. But if you notice something like that in the audio, it's not an audio problem. But hopefully it won't be an issue. But the second thing is really what's going to move the market this week, most likely, is not the Fed meeting on Wednesday, at least, although now that I just said it, it probably will be the Fed meeting on Wednesday. But it's likely to be the earnings after the bell today for Microsoft and Google. Those are two of the Magnificent Seven. You've heard that kind of that name thrown out there by just about everybody out there is calling it the Magnificent Seven. These are those mega cap tech stocks that have been driving the market for the last several months, and there's two of them that are reporting. We already had Tesla report a few weeks ago, and we have upcoming. You have Apple and Amazon. Actually, Wednesday you also have Meta too. So you got three out of those seven reporting this week. So it's likely to be a market mover, but because those are the first two, I think that we could see a market reaction tomorrow based off of that. So now we have been talking about the market being a little bit stretched, and we're still kind of in that situation. But again, sometimes the market can get these conditions and it keeps grinding higher and remains overbought. That's why you don't use just overbought, oversold as your main reason for entering or exiting a trade. But you do have to pay attention to it. And what I don't like a lot of times in these kind of situations where the market is grinding higher is, you're trained over the years to recognize this, and again, we look at probabilities, and probabilities in this situation are that the market will pull back. You want to wait for it to pull back, and most of the time, if you do that, it's going to be the right decision. But when it keeps kind of grinding higher in an overbought state, then it can get a little bit frustrating because you start to feel like you're missing the move. You got fear of missing out. It's a natural human emotion, which is, again, remember, the market is the best place on earth to analyze human behavior and what we do, what group behavior, what we do as groups, and groups tend to be very predictable or tend to be very repetitive, and that's why that fear of missing out is something that really shows up in these conditions. And the thing you really have to be disciplined about is that you're going to get caught up in it. So be aware of that, and you're probably going to be if you are holding out, waiting for the pullback, which, like I said, is historically over long periods of time is the right thing to do in these conditions, is you'll probably get drawn in. You'll finally decide to jump in and just chase the trend right when it turns, and it'll make you even more frustrated when you miss the move on the way up, and then you're jumping in just as it starts to move down, and that's where people start to feel like this always happens to me, and why does it always happen to me? Well, guess what? You're not going to be the only one that happens to. It's going to happen to a lot of people, because that's when the trend is going to change, is when the majority of the people then go chase the move. They ignore the charts, they ignore the condition, they just go, it's just, I just got to buy because I can't stand missing out anymore. And then that's when it turns. So, um, I one of the best things I learned early as a trader, and it's one of the best pieces of advice I can give to traders I teach, is to just develop a bus stop mentality. Just develop a bus stop mentality that this isn't the chance of a lifetime. This isn't the, man, if I miss this, I'll never have another chance to make money in the market again. If you miss the move, there's going to be another one. In fact, I've never been saying that this is this is the uptrend is going to die. I don't see any evidence of that just yet. What I have been saying, though, is that we just need a pullback to better entry point, and it's just that's just good trading is to wait for that next bust to come around, and then also if it does morph into something bigger and a bigger sell-off takes place, then you'll get a better entry point there as well. But the key is just don't allow yourself to get into the habit of feeling like there's once a lifetime opportunities that you're missing, or that maybe your neighbor is bragging about how much money he made, and he's making fun of you because you didn't. Don't let that get to you, because he's probably going to be losing it all in a few weeks anyway when the market does turn and he's all loaded up. And then keeps buying on the way down, keeps buying the dips on the way down. So just stick to your discipline and just develop that bus stop mentality. Now, I did want to point another thing out. This just happened today, and I can't remember where I heard it. I listened to a lot of different podcasts and things like that throughout the day. But I took a picture of the screen, and that's kind of the best I could do. But it illustrates, and so I'm going to start off by talking about this, and then we'll get into the market update routine. I'm going to flip over to this other chart because I need to go back in time. And this is a weekly chart of the SPY, and I've gone back here to October. This is September. September 18th of 2000 right here. There was an article that came out that said, I'll just read the quote. It said, a raft of economic data released Friday continued to portray an economy gliding towards a soft landing of slower growth and stable prices. So what are we hearing a lot right now? We're hearing, there's not going to be a recession now. We're probably in the midst of a soft landing. We're going to have a soft landing. Same thing was talked about here in September of 2000, right here. And again, if we were to move this chart over, we didn't see what happened after that. I mean, what do you see? You see a strong uptrend, a little bit of instability through here, a little bit of whipsawing, a little bit right through here. But then this article comes out, very bullish, very, saying that, hey, the worst is behind us. We're not going to have we're going to have this soft landing or what have you. And then look what happened right after that. We all know, the internet bubble collapse and all that. There's another one that came out. And again, notice where these are coming out. They're coming out at these tops or these peaks of optimism. October 6th of 2007. Friday stock gains were fueled by an unexpected strong employment report suggesting that the economy has enough strength to avoid recession. And then look what happened after that. Obviously, the financial collapse was right here, but that was the start of the decline. Now, again, I'm not suggesting, by no means am I suggesting that I'm expecting the same type of collapse that happened in both those occasions. But what I am saying is, if be careful, make sure we're making our decisions on the charts and and on the conditions that we see, these indicators here, overbought, oversold, and not what you're hearing on TV or I'm telling you, almost every analyst is bullish, and every pundit out there is shouting to buy when you get into these market tops, especially when you get into these crazy what I call hyper bullish type conditions, and and like I said, the trend is still up, and I'm not saying that it can't continue to move up, but recognize that make sure we're recognizing when it does get a little bit extended. Now, we may not be quite there yet, although you do have the bull market indicator right here. There's a longer term indicator. It's all the way to the far right side. Now, this can, when we're in the bear market, it got to the extreme and got even more extreme. So again, this alone isn't suggesting it can't go up further, but just recognize though that it's in that far right side. The momentum indicator, with a little bit of the softness in the market over the last couple of days, has moved it off of that extreme. But remember, we were working our way towards that extreme overbought condition. It wouldn't take much of a push higher if it does rally from here. And again, a lot of that might depend on those earnings with Microsoft and Google and possibly even Meta on Wednesday. But just recognize that it's close to that getting stretched right here. Breadth is actually in the extreme risk. And remember, breadth had been lagging for quite a while, so it's starting to get in that extreme area there as well. Although, again, both of these are suggesting it could still go higher from here. When we get to that far right side, that it's imminent. You're expecting a pullback, within days out of that kind of condition. So there's definitely some room to run. A little bit stretched though, and we've seen it kind of bounce back and forth in this area, this kind of extreme area here. Now, as we've been working through this kind of grind higher over the last little bit here. Breadth, like I said, sentiment is. I know this will get fixed here soon, but we know it's all in the far right side of this extreme reversal risk. You can see it over here on this chart. So here's sentiment right here. You can see it's really extreme, and it's been extreme for most of the year. I mean, it basically, through this whole stretch, it's been to that far right side of that extreme reversal risk range. Buy sell ratios aren't, they could get a little bit more stretched. We've seen them get stretched a little bit more stretched before. Our other sentiment indicator here, it hit that overbought area, and we did see a little bit of softness in the S&P. It pulled back a little bit. Like I said, it wouldn't take much of a rally higher. And this is what I don't know. I hate to say this because I get accused a lot. Part of my job is I've got to comment on what I'm seeing. And what I'm analyzing. And when the market starts to make lower, and I base it as best I can on probabilities, experience, what I've learned, all those things that help analyze probabilities. But when you get the market moving in the lower, or the lower probability, making a lower probability move, then obviously, you're fair game for people to make fun of you, tell you don't know what you're talking about, and all that kind of stuff. And so, but based on, again, how I would react to, Microsoft and Google earnings is, even if they do beat their numbers, and they probably will beat their numbers, or they could beat their numbers. The big thing will be the outlook. Is okay, if they gap up tomorrow or something like that, how much further are we going to go, or is it going to pull the market up? I mean, obviously they've been pulling the market up already. Remember, the market moves in anticipation. That you could make the argument then that the market has been moving based off of what they did over their last earnings report. You could see the situation where you see a sell the news type of thing that happens, where it's like, okay, I mean, it's going to be very difficult for them to. From a valuation standpoint, just a valuation standpoint, they're already pretty extremely overbought. Hard to see them going much further than that. And then even from a chart standpoint, they're pretty overbought. So can they get more overbought? That's the thing about earning announcements is I don't trade earning announcements because I've seen just crazy moves. I've seen stocks that are already overbought, really overbought. NVIDIA is a good example of that. It was already pretty overbought before their last earnings report, and they just went crazy, gapping up. One of the biggest gap ups from a market valuation standpoint, the biggest gap up in the history of the market that took place last time. So, but again, from a probability standpoint, it's more likely that even if they did gap up, they may not go that much further before either pulling back, or remember, you don't always have to pull back to correct a move. You can move sideways, but usually if you're moving sideways, you're going to be moving sideways for a long time. That's why you don't see these long sideways moves a lot of times. Instead, you see the pullback, people just selling and taking profits or what have you. So could we push higher again? Yeah, but again, this is the S&P right now. We're not too far away from the extreme level here, and we can get a little bit more extreme. We've overshot a few times, but you're just in a situation where there's not much more upside reward for the downside risk that could be there, and that's where I'd be a little bit careful. And I hope we get a decent correction here so I can finally turn bullish and people can stop accusing me of being bearish all the time. So, all right, so let's take a look at the charts and a couple areas to continue to point out. First of all, go to a longer term chart here. We want to, again, keep an eye on this area right here around that 460 area. So again, there's a pretty major resistance a little bit higher from here. So, could we work our way up to that level? It's kind of looking like the market wants to do that right now. Today's move is up pretty decent, although the VIX is kind of warning, a little bit of a warning sign today too. We'll look at that here in a second. But so we're right at basically 456, 460 is that next resistance area. And this is kind of lining up. You're not quite in the extreme reversal risk area, but if you push right to 460, you're going to be right in that extreme reversal risk area. So all that's kind of lining up as a spot. If a correction is going to start to take place, that'd be an area to look for. Now what I was looking at last week, Thursday we had this little down day right here. Friday we just kind of matched it. Tried to open higher and closed, basically had almost two candles exactly the same, almost exactly the same right there. This was looking to me like maybe wave A, wave B, and again, I was still looking for kind of a pullback right into this area right here. Obviously, with this push higher today, unless we really fade into the close, which I don't see that right now, it could still, maybe that's just a wave B and you get wave C down, but this far up, where you're almost breaking out, it's more likely that you're going to push higher. I'd say that 460 area is probably still more likely to get to that point than to pull back. But there again, once I say it, it probably means we're going to have a massive sell-off tomorrow. That's the way it's felt. And again, this is, have you ever, and I know every trader has felt like this, do you ever feel like if you just did the opposite of what you thought about doing, that you'd be right or you'd make a lot of money? That was one thing I learned, because I thought that when I first started trading a lot. Man, if I just, every time I'm convinced it's going to go up, it goes down. And if I just did the opposite of what I thought I wanted to do, I'd be rich. I thought I was the only one that thought that way. And then I started coaching, and I find out that just about everyone I've ever coached is either made a comment or thought the same thing at one time or another. I promise you it doesn't work. It won't work. In fact, I used to joke when people would use it as a criticism for me, Jerry, if I just did the opposite, if I bought puts when you bought calls and bought calls when you bought puts, I'd be rich. And my response is always, then do it. Why aren't you doing it? If you're convinced that'll make you a gazillionaire, then go do it. And I've yet to have someone that came back and told me that they are a multimillionaire because they did the opposite of what I've done. So I think it's safe to assume that it doesn't work. But I still fall into that. It's human nature, so I still fall into that trap sometimes of, well, because I'm bullish, it probably means it's going to go down, or because I'm bearish, it probably means it's going to go up. But from a chart standpoint, again, when you're pushing a breakout right here, you've got that major resistance up here a little bit higher. It should work its way towards that at least, and that could be just this week. But, you've also got, like I said, the big driver of what happens next could be Microsoft and Google and Meta. I did mention the Fed meeting on Wednesday, but we already know they're going to raise a quarter point. The market really hasn't been reacting on Fed news much lately. It's kind of shaken it off. And so it'd have to be something pretty dramatic for it to really, I think, have an effect on the market. Switch this over to so the Dow. Now the Dow has really been leading the charge in the markets. We've seen the Qs soften up a little bit lately. We'll look at that chart in a second. In fact, the Dow is, I think, within 2 days. If it moves up today, and maybe I think it's either tomorrow or it's like if it moves up again 2 or 3 more days, something like that, it'll be the longest streak of positive closes in its history. I think it was going back to the 90s or something like that, 80s or 90s or something like that, the last time it did that, where it set that record. Does that mean anything? Well, to me, it screams, again, from a probability standpoint, some people hear that and they think it means it's going to break the record. I look at it as, from a probability standpoint, it's screaming overbought. It means that we're probably really close to getting some sort of a pullback. And that's what the indicator is telling us as well. We're getting to the far right side of that box. And so now what's been happening a little bit lately, and I think what's partly fueled the Dow rally, has been people have taken some profits in some of the NASDAQ names. And so that's why the Qs have been down a little bit. So we call that a sector rotation, a little bit of rotation going on where money's coming out of tech, going into industrials and financials. Banks have been doing pretty well through their earnings. And so you're seeing a little bit of that, just money moving around there. But let's look at the Qs here. Now the Qs, you can see here, have already kind of pulled back now. Again, this chart looks to me, usually very rarely do you get just a a quick drop and then go right back up again. It does happen, but typically you'll get that suckers rally first. So this is either wave A, and maybe we get a little bit of a rally here for wave B, and then you get wave C. Kind of what happened here. Now this one had only a little one-day rally, but you had kind of wave A, wave B, wave C. Excuse me. Here though was just a real quick drop and move higher. Here was again kind of that ABC. So that's what I'm looking at right now to see if that's what's developing. If it's kind of a wave B type of a move there. Now it's backed out of it, the extreme reversal risk. So if it did want to just charge higher right there, it could. And like I said, probably a big, probably what'll determine that will be those Microsoft and Google earnings. And by the way, both of those are the lead AI stocks. So, keep that in mind that that's all you're going to hear when the market closes is AI, AI, AI. And however those stocks move will probably affect just about any other AI stock out there that you maybe been paying attention to or following. One thing I do want to say about AI in a little bit of a cautionary, just to put a little bit of balance to the hype. Okay, I believe that AI is going to be the next internet type effect on the world. Okay, the internet changed the world. I think AI is going to change the world. But be careful. What we want to make sure, if you're really looking at investing and things like that, pay attention to what happened with Meta a little while ago, because they changed their name to Meta for the metaverse, thinking that that's this is what the new wave is going to be. This is how this is where the money making opportunities are going to be in this type of universe or what have you. And they poured billions of dollars into, I don't know, billions, millions, billions, maybe even billions, into trying to develop that. And if you remember, what happened was they had their earnings reports and they were making money with their advertising, but they were losing so much money pouring it into the metaverse, and their stock just got hammered because they hadn't found a way to monetize it or make money off of it yet. And that's the way it is with any new industry you go into. You're not going to make money on it yet until you find a way to make money. And so there's the initial hype of it, and then the realization that, hey, we're not making money off this yet. And so be aware of that with a lot of because you're going to see AI stocks pop up all over. You already have stocks you never heard of last year that they're the new big thing for AI, and everyone's talking about them. But the key is going to be, is the technology producing money? Because there's usually going to be the initial hype and then the dip, which is what Meta's gone through. And then what Meta did, though, is they went right back. They said, well, we'll still do our research, but we're not going to pour that much money into it. We're going to go back to what we do well. You could see the same thing happen with some of these companies. And that's what I'll be interested to hear in those Microsoft and Google reports, is just that, I would not be shocked if you start to hear, again, they'll have their numbers they report, and then the projections going forward. I wouldn't be surprised if you start hearing comments about, are they actually making money on their AI stuff, or when do they expect to make money on that? All right, hold on just a second here. There's a question. A question on wave B. Is it possible that wave B could be one bar? Yeah, it can be. If it's a smaller correction, if it's like this one right here, that was basically a one bar wave B, but it was also a smaller correction. If this is just a smaller correction, then that could be wave B. It could be A, B, and get C, but it probably wouldn't be that much of a move down off of that. Now, keep in mind too that when we talk about ABC, it can also be a bigger move that unfolds where it's wave one, wave two, and you get wave 3, 4, 5. This is Elliott wave analysis here, and that is wave A, and then you get wave B, and then 5 waves down for wave C. It could be morph into something bigger, and that's why I keep saying. You when you're overbought, you're expecting some sort of a pullback. You don't know initially whether it's just a more shallow ABC or if it says 5 waves down, wave A, a larger ABC that ends up moving into. So it's too early to tell on that. From as stretched as we are, and again with that overhead resistance, we'll probably due for a decent correction. But we've been saying that for a few weeks now, and it hasn't happened yet. I do know though, and this is also ties into what I was talking about earlier, is that when it does turn, it turns quickly. So you don't get a big warning. You hear me. You might be tired of me pointing out bearish reversal candles, and there's been a number of bearish reversal candles lately that haven't worked or that didn't lead to the pullback. That's the warning you get. You get a bearish reversal candle or some sort of a bearish type of price action. It does come before, most of the time it does come before the big drop, but that's why I say the candles can't perfectly predict the drop. But when we get overbought, you start looking for bearish reversal candles. Now, what's happened lately is you got the extreme overbought. You get a bearish reversal candle, but it doesn't pull back very much, and that can happen. That's what happens in these unique situations where we're really in kind of a hyper bullish mode, or we just keep grinding higher. These conditions happen. They don't happen very often, but they happen, and from time to time, and that's part of what is the reason why you can't know exactly what the market's going to do. It's one of those things you just have to accept as being part of trading, and it's the market's reminder to you that as much as you think you know what it's going to do next, no one does, and no one will ever know it perfectly. But it doesn't mean we can't be on the right side of the market most of the time, which is the probability approach and all that. There's another question about a couple stocks. We can take a look at those near the end of class when we get into specific stocks. I don't want to get sidetracked just yet on that. Because then usually what happens is I start getting bombarded with everyone wanting to look at a different stock, and then we don't have a market update. So, because remember, what we're doing right now is we're looking at the market conditions, and this should be some type of this routine should be what you do. Maybe not necessarily every day, if you're depending on how active you're trading, but it should be what you do before you start getting into trades. What are the current conditions right now? Are they bullish? I want to be buying stocks. Are they overbought though? Bullish but overbought. I might want to hold off until we get a little bit of a pullback. Are we selling off in a big way? You want to kind of see what the conditions are before you start making your trades, because that can also determine how many trades. Maybe it's mildly bullish, or or maybe we're pretty extended here, but you decide to get into one trade instead of 10, and you're going to wait for the majority, get in the majority of those trades when it pulls back and gives you a better entry point. There's all these decisions you can make, but it starts with understanding the current conditions you're in. But Russell 2000 also started to pull back a little bit right through here, bouncing a little bit over the last couple days. We do want to see where there's a little bit of resistance here to pay attention to as well. Right around this 198, 199 area. So again, we saw the same thing with the SPY. Not too much further before you're bumping into significant resistance on the Russell. The Qs, let's see if there's one further back on the Qs. I thought we already broke through it. Yeah, we already broke through it on the Qs right here. But this is an area, we've already kind of come back to it a little bit right there, where maybe it's acting as maybe that's a little bit of support right there. There's major resistance up here, but this is the all-time high up here. That would be the next area if we start pushing forward on the Qs. All right, bonds. Now we did see bond yields on the 10-year moving up a pretty decent amount today. The overall trend, though, we're still kind of stuck in the sideways range on bonds we keep looking at. And until we really break out of that, there's not a lot. I don't want to spend too much time, because the trend is sideways. So you don't want to spend too much time anticipating where the next trend is. Now, this was a little bit more analyzing just the last couple of weeks. This is a little bit more impulsive off the bottom. You had impulsive down, impulsive up. This is a little bit more kind of corrective, more sideways. And then you got a little bit of a bullish reversal candle. It's not the strongest bullish reversal candle. This is an inverted hammer candle formation, but we'll see if that leads to it moving higher off of that. Gold, it had this strong move up right here. It's pulled back a little bit. I'm just looking at this to see if this is a correction for a move higher, or was this a correction within a downward move? Is this a lower high and we end up going to a lower low? A lot of that could be determined by what the dollar does. A lot of this move was going up with the dollar falling. The dollar started to rally a little bit. Gold pulled back. Now, it's possible this could be just wave A. You get a bounce for wave B, you get wave C, and then it takes off. So we'll see. There's not a lot I see in that chart that's showing a strong probable direction there. We probably need a little bit more data off that to get an idea. And really what I'm looking at is, how does this look? Does this start to look more choppy? If this starts to look more choppy and sideways over the next little bit, that'd be more bullish. You'd expect it to go up. That'd be an impulsive move off the bottom there, and then corrective. If it starts dropping, you have a little bit of a bounce today, but if it drops dramatically, this is looking more impulsive down, which could lead to, meaning that it's still got further to drop. So it's still a little bit early to be able to have an idea of what direction that's more likely to go in. Like I said, a lot of that can be tied to what the dollar does. Oil's been on a tear. It's starting to get a little bit overbought, though. And you've got a little bit of resistance up here that's getting close to. But it's not, there's still some room for it to move up higher from here. And overall, if I haven't been doing cartwheels over oil off that oil rally, because it's just we're kind of stuck in the sideways trend over the last year or so, and then, like I said, this is major resistance we're getting up into now. Again, if we break out above that, or if we pull back in a nice little bullish ABC pattern, pull back a little bit, and that'd be a good entry. It could mean that this thing could go further. You look at I've looked at a lot of oil stocks, and they gone parabolic. But I also looked, and a lot of them didn't really have a strong bullish pattern ahead of that move. It just kind of just took off. So that's one thing I always like to look at is if I feel like I missed a move, I like to go back and see where the move started, and were there a lot of bullish ABC patterns, or something to indicate that it could start that move. And a lot of these stocks didn't have it. In fact, just the opposite. There's a lot of stocks that I went back and looked at the beginning of this market tear, and they were actually in the initial stages looking like a bearish ABC pattern. This is looking more corrective off an impulsive move down, and then it just took off. And then at that point, you don't want to chase it. But it didn't look the part down here. And what would look the part down there? Well, if it had an impulsive move down and then an impulsive move up and then corrective, something like that, if I would have seen that, I would have traded it. So that's kind of what I look for as far as showing a higher probability start of a move there. So that's usually going back to those fundamentals. All right, the dollar, again, huge drop down, and then this impulsive move up. So at this point, we don't know if what direction it could go in. Now, typically when trends reverse, this is exactly what happens. You get an impulsive move down, followed by an impulsive move up. And then what should happen is when this corrects, it should correct in a more choppy back and forth fashion. If it does, that tells me the dollar is more likely to go higher. And if the dollar does move higher, that could also be something that works to be a little bit of a headwind for the markets. Markets have tended to rally a little bit stronger when the dollar is moving down. Could be a little bit of an obstacle for commodities as well if it does that. But now what happens if it comes straight back down again? Well, then you really have a question mark, because you've got impulsive down, impulsive up, impulsive down. That type of behavior, to me, creates more indecision, more of a reflection of indecision than confidence. I don't like to see that type of. It just muddies up the analysis a little bit at that point. So now we do have a little bit of a bearish candle today, so maybe this is the start of a pullback. So that's something just to watch. If it's more choppy or back and forth over the next few days, it probably means the dollar is going higher. See if it does do that. The VIX, I told you that the VIX is flashing something important today, and that is, see if it still is. But again, I remind you, what do I always say about the VIX? I say that it doesn't always tell you something every day, and if you are seeing something every day off of it, you're probably overanalyzing it. I also said that when the VIX and the market move in the same direction, pay attention. They typically move inversely. So what do we have today? We have the VIX is up slightly, not a ton, but it's up about a little over 0.5%. And the S&P, always comparing it to the SPY, not the other indexes, S&P is up 0.5%. Okay, now what does that mean? Well, nothing in a strong way. If it would have been up really strong, it would be a really strong indication, but it's a subtle indication of what you would expect in an overbought market. And then professional traders can see this. They know what an overbought market is, but they also are in a market that just keeps going higher. We've had, how many bearish reversal candles have we had? The market is shaken up. And those professional traders are thinking to themselves, well, first of all, they're not going to go heavily short, try to pick the top. But they also don't want, they know that they're in an overbought condition. The pullback is probably coming. And so the way I interpret that, and it lines up with what we're seeing on the chart, is that they're buying protective puts as they're buying their stock. So protective puts are cheap right now, or cheaper, I should say. Those market makers can recognize an overbought market as well. We have seen the put prices increase relative to calls. We've been seeing that for about the last couple of weeks or so. But so what this is telling me is that the professional traders aren't trusting the rally completely. Okay, so they're cautiously buying is maybe a better word to say. Now, do you base a trade off of that alone? No, but it's one of those clues you want to pay attention to. And again, what does it mean? It means that you start looking at significant resistance levels, which we've done. It's right up here at 460 or 461, somewhere right in there. And do you see a bearish reversal candle when you get in that area, or maybe you see one within the next few days or so? That could signal that it could be underway or about to be underway. Chip stocks rallying a little bit today, but again, is this wave A, wave B, wave C? Kind of the same type of thing we're looking at there. I will point out though that, again, this is a real subtle thing. You're not going to base your decision off of this alone, because these can just be normal pauses. But here you had a really strong move up, pulled back, went to a little bit higher high right here, pulled back, went to a little bit higher high right here. It's you can see it. It's starting to flatten out a little bit. Again, it doesn't mean, could it shake that off and go higher? Yeah, this is not something you're going to base a decision on, but I just want to start recognizing momentum shifts. It's losing momentum. It's taking more work to push it higher, and it's not going much higher when it does. If you look at it this way, when did it break out? It broke out right here. What if you bought that breakout? Well, it didn't go anywhere, and then it dropped. Okay, what if you bought this breakout right here? Well, it really didn't go much further there, and then it dropped. It's real subtle, but it's showing a little bit of losing momentum. Again, you're not going to base a decision on that, but I want you to recognize that behavior there. Transports have been really strong. Again, this is something you start to see transports break down in any way. Could be a leading indicator for the industrials, the Dow industrials as well. Seen it pull back a little bit. Let me go back to that chart here, but not getting. I mean, this looks actually kind of a corrective type pullback right here. Still looks pretty bullish to me. But it's also getting a little bit extended. Wouldn't take much of a move higher to push this back into extreme reversal risk as well. So, but it does explain, why the Dow has been outperforming. The transports have been kind of leading that rally for the last little bit. Bitcoin, I still like the Bitcoin chart. I still think this is just completing an ABC pattern, bullish ABC pattern for a move higher. You got this impulsive move up. This is corrective. Now we're at a critical spot though, because if it goes any lower than this, that changes the probabilities, and that's why my stop is down below here. if you look at a retracement of that last move up, oh boy, what happened there? Got a double thing. But we're right at the 618 retracement. I don't know what I did there, but here's a 618 retracement. We're right at it. So if we drop below that, it starts to reduce the probabilities. What probabilities? Well, let me get rid of this here. We can see. It makes it, if it goes below here, it makes it less likely that this is a pullback within the uptrend and more likely that you're going to work your way back down to these lows again. Now, you can have deep retracements. You can get down on these levels and go up. But again, I'm talking just in terms of probabilities. The probabilities start to shift right here. Doesn't mean they shift dramatically all at once. They start to diminish. Each time you're going lower, it becomes less likely you're going to, it's a correction within the uptrend, more likely you're going to move down towards here. So we really don't want to drop below that. And if it does, I'll get stopped out. But this is looking like a beautiful correction here for a move higher. We'll see if it holds. All right. I'm going to take a look at a couple of stocks. Before I go over the other ones, I'll take a look at a couple of stocks here that were mentioned in that were questions. I know you've been patiently waiting. Just a second here. OPRA looks to me like it's in a C leg of a ABC correction. So that looks like wave A. A little bit of a bounce for wave B. It's probably in wave C. Now, wave C will typically go beyond the end of wave A. So if that is an ABC, and it will usually be about the same length as wave A. That's another thing we know about ABC patterns. So you're looking at probably a little bit more downside down to around here. So, yeah, I mean, if you're looking at an entry, I wouldn't enter just yet. I'd probably wait to see if it comes down a little bit further. Now, if it breaks out above here, it probably means that it's done. It's probably not going to go down any further. That'd be a pretty short wave C, but you can have short wave C sometimes, so that can happen. But yeah, I'd probably wait for an entry on that one if you're watching, to keep it in your watch list or what have you. And then he's also mentioned BMEA. Kind of the same thing. You're look at a longer term chart of this. Yeah, that's probably just wave A. Notice how impulsive that is right there. Now this is not a real long wave B, and usually you expect wave B to be a sucker's rally where it comes up a little bit further and then you get wave C. It looks like it's in wave C. That doesn't look, definitely one you'd want to stay away from right now, because that looks like that's a pretty ugly. Another way to look at it too is you don't come crashing down that fast and go right back up again. So even if it does start to go up, and wave B might not be done, and that would be probably I'd probably say wave B. This could just be the start of wave B, and wave B rallies up into here, but it would probably be very choppy if it did, and then have another move down. So you're probably looking at a lot of time before this is done correcting. Stocks don't typically get beat up like that and then go right back up again, unless there's a catalyst of some sort. Like there was maybe like an accounting issue that freaked everyone out, so they sold, and then they come out and they said, no, it wasn't an accounting issue, or we corrected it, or what have you, and it's not that big of a deal, and then people go right back in it again. and this is a biotech stock, so maybe it was something that a drug that failed some test, and then it, I don't know, they find out the test was wrong or something. The test, it could. I'm not saying it can't bounce back, but from a probability standpoint, it probably has a little bit further to correct. It's kind of like a boxer that gets clocked. They hit the canvas. They might get back up again to fight. They might not be knocked out, but they're not going to have all their wits together. They're going to take a little bit of time to figure out what their name is again. And that's kind of what happens with stocks that get slammed like this. Is they just don't go right back up again. So just always, again, from a probability standpoint, just learn that. It's real easy to find a reason that if it just goes right back up here again, then I got in down here, I'm going to double my money. True, but you're going to be in that thing for several years before it finally it makes you any money. So you could probably put your money elsewhere until it's done falling or done getting slammed. All right, real quickly here, a couple of stocks off of the new buy list. Where is it? Oh, I'm not in the new buy list. Here's the new buy list right here. This FTI. Some of these, again, you're probably in the later stages, just like the market, you're probably in the later stages of the trend. So you're just trying to keep trading. You're trading that momentum, but just be aware that probably at some point you're probably going to get a bigger correction. But I'm not saying you can't ride some of these for a little bit. So how I would trade this? Obviously, you're could be coming out of a correction right here. You've got an uptrend. Could you trade just the momentum where this keeps going higher from here? Maybe you put your stop down below here. So you got a real clear management spot right here where you can put a stop down below here. It's just about to break out. And maybe you ride it until it gets to the far right side of that extreme reversal risk, and then you get out or something like that. So in these late stages where maybe the S&P only has a few more points to go higher, and it may not, maybe the S&P blows through this and we get a real crazy 1999, 2000 situation again. So some of these are kind of doing that where you can just kind of trade that momentum. Let's see here, another one. Oh, I wanted to show you this on NTNX. Whenever stocks make big gaps, I don't like to chase them. And again, this gets back to probabilities. When you get a big gap, and I'm talking a real noticeable gap, either the stock will go a little bit higher and then pull back, or it'll immediately start pulling back, or it'll move sideways for a while and then maybe go higher or pull back. But the chances of it really taking off from that big gap up are usually pretty rare. They do happen, which is what, again, you see it happen once. Where it does happen, you think, you start buying all these big gaps, and you'll find is, because I've done this, a lot of this stuff I teach is from personal experience, is that the majority of the time it's going to do just what it did here. Had the major gap up, went a little bit higher, moved sideways, and then came all the way back down. So if you miss that move, you're like, oh man, I wish I would have gotten in before that big move. A lot of times you're going to get another chance. You're better off waiting for a pullback or waiting for a correction than chasing that news-driven event. NVIDIA did this, okay? Now, NVIDIA hasn't filled in its gap yet or pulled back from its gap, but it will at some point. It's likely to come back and trade, at least come back into this area here. And now, again, this is one of those. Well, even this one, again, it gapped up. Then what did it do? It moved sideways. If anything, I'm just saying, just don't go. Just be careful, not just buy the gaps, because you'll notice that most of the time you could probably get a better entry point, And but anyway, going back to that chart or going back to that stock, it had its pullback and then it started to move back up again, and it's getting ready to break out. Nice little trend overall. You got this cup with handle formation. It can break out of this area here. It's a pretty bullish looking chart. Couple more here. Decker's Outdoor, again, kind of probably a momentum play. Little correction right there. Could it go a little bit higher before, getting extremely overbought? Another one on here was Tech Resources, mining company. A little bit of a kind of a bowl-shaped move right here that's breaking out of. So that's a pretty bullish looking candle right there, or chart right there. And then one more. This LOMA. Again, kind of that bowl-shaped move, maybe an ABC pattern right here. And again, I like these because you can manage them pretty easy. Put a stop down below here. It breaks out. It could really take off. You could take the distance of the top of the bowl, the bottom of the bowl, project that upward. Question. This is back on those charts. I already have these. Should I hold or bail? I can't tell you that. I can't give you specific advice on what to do, but I did analyze them and tells you what I thought, so you could use that information I told you about the charts. And if you need to go back and review the recording of the class to kind of go over that again, you can. But yeah, I can't give out specific financial advice. I'm not a licensed financial advisor, so it'd be illegal for me to do it. But yeah, you'll have to make that decision. But what I can do is exactly what I did. I can analyze the chart, and then you can decide what you want to do. But I can't tell you what to do. All right. So I did go over some of these patterns here, but remember what our analysis was. Just recognize that condition of the market, a little bit stretched, getting overbought, approaching key resistance levels. Maybe what your approach is you trade that. Just we could go up a little bit further over the next few days, trade that momentum, or if you're concerned about what Microsoft and Google might do or the Fed meeting might do this week, not a bad thing just to sit on the bench at the bus stop, wait for the next bus to come around. We're going to get another opportunity to get in. If this is a bull market, bull markets last a long time. Mostly they're usually a year to 2 years sometimes that they last. And we're just now over the last couple months starting to look at this as possibly being a new bull market. So we'll see. I also go back to what I said at the beginning of class. Sometimes some of these headlines come out right before the crash. And if you've been with me for a long time or for a while, I haven't said it for a while because there really hasn't been a reason to say it. But I have yet to experience a bear market and a major market sell-off like we had last year without having a panic sell-off be part of it. We never got a panic sell-off. It's still bugging me, still making me wonder if we're just getting set up here for it. And that's part of why I read that stuff in the beginning of class, is that that's if you're looking for someone out there to warn you that it's coming or that could come, that's not where it's gonna show up. It's gonna show up in the price action and the patterns, and that's what you want to pay attention to. I don't see it yet. I'm not saying that, but just be aware of that. I'll point it out if I see it in one class. I'll point it out, definitely point it out, let you know when I think it's underway. But anyway, have a great week, everyone. Bye now.